They say it's not your fault if you're born poor. You don't really have much of a choice in that, but if you die poor, well, that's on you. This is Foxfire Finance, and you're committed to spreading the great news and concepts of the FIRE movement to anyone dreaming of a better life. We aim to help you achieve your goals by providing meaningful tips and strategies that will bring you closer to your dreams of financial independence and retiring early. In this video, we're gonna talk about the bad money habits that keep you from being financially free. This is going to be a major reality check, so buckle up and brace yourself for impact. But first, don't forget to subscribe, burn that like button, and ring the notification bell to be updated on our latest releases to guide you on your way to FIRE. Ever been curious on why some people are successful financially and some people aren't? How do they do it? Is there some kind of formula behind all their success, or is it just pure luck that's playing a major role in their lives? Money is not a simple thing to manage, that's for sure. And for that reason, we can't assume that luck is at play whenever someone becomes rich or good with their finances. In fact, if a person tends to fail at handling their money, it's even more likely that they're making serious mistakes with how they handle it. Anyone can be rich, but because of bad money habits, people often end up losing their cash. What's even worse is that most of the time, they don't even know that they're messing up their chance at becoming financially free. With that in mind, here are 9 money habits that will keep you poor unless you do something about it. 1. Not keeping track of your spending. Do you make it a point to check where your hard-earned money is going? Not tracking your expenses can have several harmful consequences for your financial health. When you don't keep track of your expenses, it's easy to lose sight of where your money is going. This can lead to overspending on non-essential items and impulse buying, which can drain your budget and could lead to financial stress. According to recent studies, Americans spend $18,000 on non-essential purchases such as lattes, unnecessary clothes, Amazon finds that they don't really use, and a lot of things that are basically just additional clutter in their homes. It's a sad reality, but this is why people often remain struggling with their money instead of having more freedom with it. Remember that if you're aiming to be rich, you should know how to stick to your budget. Being completely aware of your spending allows you to know where your limits are so you can still save at the end of the day. 2. Borrowing the maximum that you are qualified for. Getting qualified for a $5 million loan for your home doesn't necessarily mean using all of this money up. You may think that having a high credit limit is a sign of you having a bigger budget, but this can bite you in the ass in the long run, especially if you're unaware of how much your regular income can handle when it comes to paying the loan and the interest back to the bank. Borrowing the full amount means taking on a higher level of liability. This can lead to higher monthly payments and a longer repayment period, resulting in more interest paid over time. A higher debt load can also put pressure on your budget and limit your financial flexibility. What you can do is to borrow a portion of what's allowed of you and make use of the property you buy as another means of earning income. This income will now support your monthly payments and can even give you additional savings instead of added expenditures. 3. Not paying off your credit card balance in full. Speaking of debts, let's talk about your credit card debt. Paying your credit card debt in full each month is considered a good financial practice for numerous reasons. Consistently paying your credit card balance in full helps you maintain a positive payment history, which is a crucial factor in your credit score. A higher credit score can lead to better interest rates on loans and improved access to credit. Aside from that, paying your credit card balance in full by the due date lets you avoid any interest charges. Credit card interest charges can be high, and carrying a balance from month to month can lead to huge interest costs over time. And of course, having no outstanding balances on your credit card gives you peace of mind. 4. Ignoring taxes and not making an effort to understand them. You might think that ignoring taxes doesn't really hurt you that much financially, because what can you do, right? While paying taxes is something we can't skip, there are ways to significantly save money if a person is aware of how taxes work. Someone who knows about taxes will surely know that the higher the income pre-tax, the higher the tax liability would be. However, there are a lot of ways actually to reduce taxes, and one of which is checking if your employer offers a 401k. The balance being contributed to this retirement account is not included in your taxable earnings, and they will only be taxed if you withdraw your earnings when you reach 59 and 1/2 years old. If you're a business owner, you can set up your business as a limited liability company or an S corporation so you can save yourself on higher self-employment taxes. There are a lot of ways out there to reduce your taxes and maximize your saving potential, but this will only be possible if you make yourself informed properly on how taxes work. 5. Not setting up retirement accounts. One of the biggest mistakes that keeps a person poor is ignoring the importance of retirement accounts. If you're employed, the first thing that you should check is whether your employer offers 401k. Retirement accounts such as traditional IRAs and 401ks offer tax benefits that help you save money. Contributions to these accounts are often tax deductible, meaning you can decrease your taxable income for the year, which means less tax to pay for. Retirement accounts give opportunities to save a serious amount of cash, especially if you start early. A Roth IRA or a Roth 401k, for example, allows you to contribute up to $6,500 in a year if you're younger than 50, or up to $7,500 if you're 50 or older. While contributions are made with after-tax dollars, withdrawals after you reach 59 and 1/2 years old are completely tax-free. A traditional IRA or 401k, on the other hand, allows you to contribute up to $22,500 a year if your age is below 50, and up to $30,000 a year if you're 50 or older. Again, the earnings from these are tax-free if you withdraw them when you reach 59 and 1/2 years old. Take the chance that these retirement accounts offer, and you will surely find yourself saving so much more upon your retirement. 6. Not seeking additional sources of income. Relying on a single source of income can be risky, especially if that source is subject to fluctuations such as job loss or changes in the market. Multiple income streams provide a safety net that can help you weather financial challenges. With additional income streams, you can also allocate more finances towards paying off debts, which speeds up your progress towards becoming debt-free. Extra income can be directed towards savings and investments as well. As a result, you get to build more wealth, achieve financial milestones, and enjoy greater financial freedom. Earning extra can come from doing side hustles or even starting your own business. Although there's some level of risk when it comes to venturing in a business, it would still be worth a try because of the ease and convenience that business owners have these days through the use of the internet. You can even start your own business while working from home and without a physical store or even stocks. 7. Lifestyle inflation. Here's one thing most people are guilty of. Lifestyle inflation refers to the tendency of people to increase their expenses as their income grows. While it's natural to want to enjoy the benefits of your hard work and improve financial situation, lifestyle inflation can have negative impacts on your overall financial well-being. Lifestyle inflation can slow down your progress towards achieving financial milestones. The more you inflate your lifestyle, the longer it may take to pay off debts, save for major purchases, or achieve financial independence. When you escalate your expenditures as your income goes up, you may have less money available for saving and investing. This can actually deter your ability to reach your financial goals, such as building an emergency fund, or saving up for your retirement, or buying yourself a home. And sometimes, the need to maintain a certain standard of living can cause anxiety and reduce your overall well-being. It's still best to keep your spending to what's enough for you despite having more earnings coming in, as this would result in higher net pay and more money to put in savings or investments. 8. Ignoring the importance of purchasing quality items. Choosing quality over cheaper alternatives, even when you're trying to save money, can often be a wise and financially responsible decision in the long run. While higher quality products or services might come with a higher upfront cost, they can offer several advantages that contribute to greater value and savings over time. Let's talk about buying a good quality pair of shoes as an example. It may be a bit costly at first, but it would mean having a reliable pair to wear for years to come. Then this cost is much more advantageous compared to buying cheaper versions that would be damaged a few months after purchase. Being frugal includes considering quality over price. It's not synonymous to being cheap, which means always looking at the price tag without even considering the quality of what you're buying. This is a good point to consider if you want to improve your money habits. 9. Forgetting about the worst that could happen. While it might appear counterintuitive, planning for possible setbacks and adverse circumstances is a crucial strategy for ensuring your long-term financial health. Building and maintaining an emergency fund are key factors of financial preparedness. An emergency fund offers a financial cushion to cover unforeseen expenses such as medical bills, car repairs, or job loss. Having this fund in place reduces the need to rely on credit cards or loans during times of crisis, helping you avoid debt and financial strain. Preparing for the worst involves identifying potential risks and taking steps to mitigate them. This might include purchasing insurance coverage such as health insurance, life insurance, disability insurance, or homeowners insurance. Insurance helps protect you and your family from financial devastation in an unforeseen event. While you are always optimistic about your future, it's still the best to practice being prepared for unexpected delays and challenges along the way. It gives you a better perspective of things and how you should plan to achieve your financial independence. Being poor may not be something to be ashamed of, but allowing yourself to remain in this situation when you can change it isn't something to be proud of. And if you're already tired of being poor, then now you know what to do. Did you find this video helpful? If you did, burn that like button and don't forget to subscribe to our channel for more tips on how you can reach your financial goals. Until next time, we are Foxfire Finance and keep that fire burning.